This is Skill and Active Management. It's joint work with Luboš Pastor and Rob Stanball. And I want to start with a simple idea, which is that a mutual fund's performance depends not only on skill, but possibly also on scale. So here's a simple example. Suppose that I'm running a mutual fund, and so is Roni. Roni is also running a mutual fund. Even though Roni has much more skill than I have, I may still be able to outperform him because Roni's mutual fund is much bigger than mine. And it's hard for Roni to deploy all that extra capital. So this is why in order for us to learn about skill, we need to first understand the effects of scale. The question we ask in this paper is, what's the nature of returns to scale in active fund management? So we're going to look at two hypotheses. The first is decreasing returns to scale at the fund level. In other words, as a mutual fund's size goes up, that causes the fund's performance to go down. And the logic is that larger funds, they make larger trades, which have larger price impact, and that hurts the performance. So this hypothesis shows up most famously as an assumption in the Burke and Green theory. A few empirical papers have tested the hypothesis, finding mixed results. Our contribution here will be to revisit this hypothesis with different econometric techniques that avoid some biases that are plaguing this literature. The second hypothesis is industry-level decreasing returns to scale, which says as the overall mutual fund industry gets bigger, that causes all funds' performance to go down. And there the logic is that as there are more mutual fund dollars out there competing and chasing after mispriced stocks, well, that makes prices move, and that makes it harder for any mutual fund to find a mispriced stock. The theory here is from my co-author's earlier paper, and to our knowledge, this is the first paper to look for evidence for this hypothesis. An important caveat is that these two hypotheses, they're not mutually exclusive. They could both be true, they could neither be true, we'll see. Here are our main results. So the paper's main result is evidence consistent with decreasing returns to scale at the industry level. The industry size performance relation, it's especially strong for mutual funds with high portfolio turnover, for funds with high return volatility, and for small cap funds. In contrast, we find only mixed evidence of decreasing returns at the fund level. So all of our estimates will point to decreasing returns, but once we remove econometric bias, we lose statistical significance. So these results on scale have some interesting implications for skill. So we're going to offer a new measure of mutual fund skill that adjusts for scale. And with that new measure, we show that active funds have become more skilled over the last 30 years. Surprisingly, though, their performance has not improved. So skill has gone up, but performance has not. We also document a negative relation between mutual fund age and performance. So first of all, in the time series, the typical mutual fund's performance decays over its life. And then in the cross section, we find that the young mutual funds outperform the old mutual funds in a typical month. If you take all these results together, they are consistent with the following simple story. The story is that new mutual funds tend to be more skilled than existing funds, possibly because of improvements in education over time, or possibly because these new funds have a stronger grasp on technology. So given their better skill, these new funds, they tend to outperform initially. They outperform their benchmarks. They tend to outperform the older mutual funds at that point in time. But as all these funds grow older, their performance suffers. And the reason is that the mutual fund industry is getting bigger and bigger, and that's associated with continued arrival of skilled competition that's going to hurt everyone's performance. So that's our story. I want to start then with our econometric methodology. And all these points will be about the first hypothesis, the fund level hypothesis. it's going to be tough to measure the effect of fund size on performance because fund size is endogenous. So to illustrate the challenges, I want to go through three possible estimation approaches, starting with this first one, a very simple pooled OLS regression. So in this method, we're going to run a big panel regression of fund performance on lagged fund size. If size is randomly assigned to funds, then we can interpret the slope beta as measuring the effect of size on performance. But we all know, of course, that size is not randomly assigned to funds. In particular, if you think that size depends on skill, then this regression suffers from an omitted variable bias. The problem is that we're not controlling here for skill. So here's an example, and this is basically going to be the Burke and Green example. Suppose that larger funds tend to have more skilled managers. Well, that's going to make their higher skill will tend to offset any decreasing returns to scale, meaning our OLS slope of beta here is going to be biased upward towards 0, meaning we're less likely to detect any decreasing returns to scale, even if they do actually exist. So a quick word on the literature. Almost every empirical paper in this literature is using method 1. There's one important exception, which is this nice new paper by Royer and Zitzowitz. They use a regression discontinuity approach. They find no evidence of decreasing returns at the fund level. We're going to address the endogeneity problem differently. We're going to take this intercept and we can replace it with a fund-specific intercept. In other words, we can re-estimate this OLS regression with fund fixed effects. So now, skill is no longer omitted because the fixed effect is controlling for it under the assumption that skill is constant over time for a given mutual fund. And we'll come back to that assumption in a bit. So now, all of our identification is coming from variation over time within a fund. So in other words, I'm going to compare my mutual fund when it's big to my mutual fund when it's small. So while the fixed effects, they solve the problem of omitted skill, they actually introduce a second problem, which is a finite sample bias. The problem here is that our residual is positively correlated with the innovation in our regressor. Or in simpler language, when a fund has a large return, the fund subsequently gets bigger. And that correlation delivers a bias that's related to the well-known Stamball 1999 bias. In particular, it gives us OLS estimates of this beta that are biased downward, meaning we're more likely to detect decreasing returns even when it doesn't actually exist. The good news is there's a third method that solves these problems. It relies on recursive demeaning, or RD for short. We did not invent this. This is from a 2010 paper by Hjalmarsson. We're going to start with the same model as before. We're still going to have these fund fixed effects, which are going to control for skill. But now, instead of using OLS, in a first step, we'll recursively forward demean each variable. For example, forward demean size is actual size minus this fund's average size, where in computing this average, we're only going to use the forward-looking observations for that fund. The nice thing about demeaning is that it makes the fixed effects drop out, leaving us with a simpler model that we're going to estimate it using instrumental variables. In step 2, we instrument for forward demean size using recursively backward demean size, which is defined similarly. Backward demean size, it's actual size minus this fund's average size. But now, in this average, we're only going to use the fund's past observations. Why does this work? Well, it works because our instrument is correlated with our endogenous regressor, but not with the forward demeaned residual. Why is that plausible? Well, we think it's plausible because our instrument uses information from time t minus 1 and before. And we think it's plausible that past information should not help us predict future innovations in returns. In other words, I've used relevance and exclusion conditions that are likely to hold, leaving us with an unbiased estimator. So to summarize methodology, we've got these three approaches. The first one is pooled OLS. It's biased due to omitted skill. Method 2 is to throw in some fun fixed effects, but that's biased toward detecting decreasing returns. It's only this third RD method that's unbiased. So we're going to rely on this third method to test for fund level returns to scale. So data, we're going to combine data from CRISP and Morningstar going back to 1979. One advantage of doing that is it lets us check accuracy across databases, and we do that following the extensive data work by Burke and Bensbergen. We only include domestic, equity, active, mutual funds with some non-trivial size, leaving us with a big panel of data. Here are the three key variables we use. The first is our performance measure, which we call gross R. It's the fund's return, gross of fees. We're going to do a very simple risk adjustment by subtracting off Morningstar's designated benchmark return. For example, if Morningstar tells us that this is a large growth fund, we'll subtract off the return on the Russell 1000 growth index. Our measure of fund size is just the fund's assets under management, and then we do a simple inflation adjustment. Our measure of industry size is the combined assets of all the mutual funds in our sample. We then scale that by the total market size of all CRISP stocks, so that our measure of industry size is capturing how big is this industry relative to the universe of stocks that they're allowed to buy.
Do any of these funds use leverage?
To my knowledge, if so, it's trivially small for these equity mutual funds. So here's what's happened to this industry over the last 30 years. We've seen dramatic growth in the mutual fund industry. It's grown from around 2% of CRISP to around 17% more recently. Okay, our first main results. So these results are on fund level returns to scale. Top panel has results from our main sample, which goes back to 1993. Bottom panel results in our extended sample going back to 1979. And I'm going to show you results from those three empirical approaches that I discussed, starting with a naive OLS regression. With naive OLS, we get a marginally significant negative relation between lagged fund size and returns. When we throw in fund fixed effects, we get a very strong negative relation, but we know that we can't say much from this column because we know this approach is biased toward giving us a negative relation. Finally, when we use the RD procedure, which is the only one of the three that's unbiased, we still get a negative relation, but now we've lost statistical significance. So again, all three methods are pointing us toward decreasing returns at the fund level, but when we remove bias, we lose statistical significance. What about economic significance? Well, if I take the most negative slope we find, this slope tells us that an increase in mutual fund size by $100 million is associated with a decrease in performance of 2.5 basis points per year, which seems relatively small. This is fund size. What about industry size? We replace fund size with lagged industry size. And either using a simple OLS fixed effect regression or the RD approach, we're getting a strong negative relation between industry size and performance. That's consistent with industry level decreasing returns to scale. What about economic magnitude? Well, if I take one of these top slopes, it tells us that a 1 percentage point increase in the mutual fund industry size is associated with roughly a 25 basis point per year decrease in fund performance. We can also run a horse race between fund size and industry size. I'll go straight to the RD column. We still find a significant negative relation with industry size, but not with fund size. So these are the results on scale. Next, I want to talk about skill. We want to measure mutual fund skill in a way that adjusts for scale. Conceptually, our measure of skill is going to be a mutual fund's gross alpha when fund size and industry size are hypothetically 0. In other words, it's going to be the fund's average benchmark adjusted gross return on the fund's first dollar invested, when the fund is facing no competition from other mutual funds in the industry. Specifically, our skill measure is going to be that fund-specific intercept A in the panel regression of performance on lagged size, lagged fund size and lagged industry size. To allow the slopes on size to vary across funds, we'll interact size with fund characteristics like portfolio turnover, return volatility, and stock size. So remember, at this point, we're assuming skill is constant over time for each fund, and we'll relax that soon. But the first step now is to get each mutual fund's skill level, and then we can track the distribution of skill over time, which I've plotted here. So what we've seen over the last 30 years is an increase in skill. You see it in the median skill, the mean skill, but you especially see it at the very top of the skill distribution. A natural question then is, well, if skill has gone up, does that mean performance has gone up? And there the answer is no. Here I've plotted average mutual fund performance over the sample, and I certainly don't see an upward trend in performance. So how can we reconcile flat performance with increasing skill? Well, the answer is in this picture. Remember that the mutual fund industry has been getting bigger and bigger. That's hurting mutual funds performance due to decreasing returns at the industry level. Or more simply, our story is this. Our story is students graduating today are smarter than students graduating 30 years ago. But these students graduating today, they're entering a larger and more competitive mutual fund industry, which is going to make it hard for their superior skill to translate into good performance. That's our story. So in my last few minutes, I want to talk about age, because all these results so far have interesting implications for fund age. The first prediction is a time series prediction. So if a fund's skill is constant over time, as we've assumed so far, and if we're facing industry-level decreasing returns, as we've documented, together with an industry that's getting bigger and bigger over time, then we should see performance decaying over the typical mutual fund's life. And that's exactly what we see in the data when we run a panel regression of performance on fund age with fund fixed effects. That negative age performance relation, it's even there if you restrict the sample to funds that are at least 3 years old to address any incubation bias. Remember, our story here is that this is all being driven by industry size. My story is that my skill is constant, but the industry is getting bigger and bigger, so my performance is going to go down and down as I age. So if that story is correct, then if we were to control in this regression for industry size, the slope on age should not be negative anymore. And that's exactly what we find when we include industry size. In fact, in some specifications, the slope on fund age switches signs to become marginally positive. So these results, they're all consistent with the story so far. But furthermore, this positive slope on age is interesting in its own right, because a positive slope on age suggests that there's some learning on the job happening, meaning as I grow older, I learn some things that help my performance, holding all else constant. Most importantly, holding the size of the industry constant. So this spurred us to think more about learning on the job, and specifically to adjust our skill measure to allow a mutual fund's skill to change over time. Specifically, we're now going to allow skill to vary with age. So conceptually, our measure of skill is the same as before. Skill is still going to be a fund's gross alpha when fund size and industry size are 0. But now, we're going to allow a mutual fund's skill to vary with T. Specifically, we're going to allow it to vary with the fund's age. So now skill is the fund effect plus fund age times the slope beta, where we're going to estimate that slope beta in a similar panel regression as before, but now we're going to control for fund age in addition to fund size and industry size. So now we're going to measure each mutual fund skill in each month. And then we can track the distribution of this new measure of skill, just what I've plotted here. Now we see an even steeper increase in skill over the last 30 years, which makes sense. It makes sense because now there are two reasons why skill has increased. Number one is entry by more skilled funds. But reason number two is learning on the job within each fund. So this is our time series age result, but there's also a cross-sectional age result. Remember, part of our story is that new mutual funds have more skill than the typical existing mutual fund. If that's true, we should see the new mutual funds outperforming the old ones in the typical month. And that's what we find when we look at age-based investment strategies. So here we're sorting mutual funds into portfolios based on the mutual fund's age. So here are funds aged 0 to 3 years. Here are the funds that are more than 10 years old. And what you see in their average performance is a monotonic decline in performance with age. And to test for significance, we can go long the young mutual funds, short the really old mutual funds, and you find a significantly positive long short return. So this is consistent with this idea that the newly entering funds have more skill than the existing ones. And so I don't have time to talk about robustness, but I want to address two questions that sometimes come up. So one question is, does skill operate at the fund level or at the fund manager level? Because after all, a mutual fund can and often does switch managers over time. So to address that comment, we've rerun all the analysis with manager fixed effects in place of fund fixed effects. All the main conclusions go through. A second reasonable question is, well,
Sorry, so what did you conclude from that?
So our main conclusions are robust to an alternate assumption about skill. Main conclusions being industry level decreasing returns to scale, mixed evidence on fund level returns to scale, and an increase in skill over time.
Skill for manager?
So it would be both, right? Remember, it's the average skill in the industry. So part of that is due to a composition effect, part of it's due to learning on the job within each manager or fund. Thank you. All right, so the second question is, well, how should we be measuring industry size? We currently include mutual funds, but shouldn't we also include hedge funds? So what we've done is we've come up with alternate measures of industry size that include hedge fund size and various combination of other professional management size, and all the main conclusions, again, go through. So to conclude, the main result of this paper is strong evidence of decreasing returns to scale at the industry level. Didn't have time to show you the results, but this relation is especially steep where you would expect it to be steep. It's steep for the most active mutual funds. So the funds with high portfolio turnover and highly volatile returns. And it's also the most steep for the funds trading in the most illiquid parts of the market, so the small cap funds. We only find mixed evidence of fund level decreasing returns, so we think that the jury is still very much out on the fund level question. Once we adjust for skill, we find that skill has increased over the last 30 years, yet performance has not, because the industry keeps getting bigger and bigger. And we also find this negative age performance relation, both in the time series and in the cross section. And that's consistent with our story, which is a growing industry level decreasing returns, and entry by higher skilled managers and funds. Thank you.
Start discussing.